This is a message for all investors who started investing in mutual funds post 2020. Why this crash feels different. The 2026 West Asia War is the first real test of investor patience in the last 6 years. In 2022, when the Russia Ukraine war started, the markets did crash, but that was different because the crash came after a huge rally post COVID. Even post Donald Trump's election, the Nifty fell down from 26,000 to 22,000, but that was after it went from 15 to 26,000, a cool 60% returns in just 2.5 years. So investors were sitting on good returns both the times and expected some correction sooner or later. At the beginning of 2026, Indian equity markets had delivered zero returns for the last 15 months. Investors were tired and were expecting the markets to start going up on triggers of GST cuts, India US trade deal, and increase in corporate earnings growth. The portfolio CAGR had moderated to normal levels, and then markets crashed. If you started investing in 2020, you saw portfolio returns of 20% plus per annum by 2024, and that has now moderated to 10 to 12% per annum. If you started investing in 2023-24, you have not seen double digit returns in 2 to 3 years of your investing journey. In both the cases, you're wondering, does this even work? Markets can give no returns for a long period. See, there have been multiple instances in the past when the Indian markets have consolidated for 3 to 5 years or even longer and later delivered strong returns. Take the example of an SIP in a Nifty index fund started in January 2007. In the first 6 years, returns fluctuated and it was practically zero returns after 6 years. Even after that, till year 10, the returns were well below the expected 12% per annum mark. Keep in mind, I'm talking about the index, not any individual fund. Investors who continued investing and stayed invested during this consolidation years were rewarded well when the markets rallied. If you stopped investing and sold off your holdings, you didn't make money. SIPs in equity funds are best for long term goals. If your financial goals are 15-20 years away, then you should be glad that there is a correction in the initial years of your investing journey as you're able to accumulate units at lower NAVs and build up capital. When the rally comes, you will make money on a bigger capital base. Imagine someone's daughter was 2 years old in 2007 and that person started investing 10,000 per month in the Nifty index. Now their daughter is 21 years old and the value of 10,000 per month is close to 80 lakhs on a total investment of just 23 lakhs. In September 2013, the value of their SIP was just 9 lakhs on an investment of 8 lakhs. The magic of compounding works best for goals which are at least 10 years or more away. So, what to do when markets are crashing? Geopolitical tensions keep popping up once every few years. India tends to get hit hard because of our dependence on energy imports and depreciation of currency. In good times, because of our growth rate, the Indian markets tend to trade at a premium to global markets. But when things get ugly on geopolitical fronts, this valuation premium erodes, leading to a significant underperformance. The Nifty was trading at 21-22 times earnings in September 24, and now it is trading at 17-18 times earnings. Despite growth in corporate earnings, the Indian markets have not done well. Now 17-18 times earnings is close to long-term average. If at this time you can buy on dips, then you will essentially bring down the average purchase NAVs for units which you acquired at a premium valuation over the last 2-3 years. If your monthly cash flows do not allow lump sum investments, then don't worry, just continue your SIPs. A lesson on diversification. Investors are always chasing recent performers. In 2023, you were probably all in on small cap funds. You bought the hype that small caps deliver better returns in the long run because of post COVID jump in small caps making the 5, 10, 15 year returns data look great. In 2023, gold was not shining. And in 2025-26, just look at the flows into gold funds. Just because an asset class has done great in the last 2-3 years does not mean you go all in on that for the next 15-20 years. Additionally, Indian investors need to understand that the rupee depreciating against the dollar is a risk, and there are two ways you can hedge against that: gold and foreign equities. Now, RBI's limits on foreign equity investments by mutual funds didn't allow for proper diversification into foreign equities post 23-24, and the available ETFs have started trading at a premium which is not justified. So you can explore gift city funds that are coming up, or the more tax complicated route of investing directly into foreign equities. Investors always run to diversify after an event has occurred, but you really should diversify from day one of your investing journey. It isn't too late to start diversifying now. Years from now, this phase won't be remembered as the crash that scared you, but as the phase where you quietly built your wealth. Every long term investor goes through this phase. The ones who make money are just the ones who do not quit.